McGraw-Hill Audio presents The Intelligent Asset Allocator, How to Build Your Portfolio to Maximize Returns and Minimize Risk. Written by William J. Bernstein, read by Barrett, Whitener. Preface. On July 31, 1993, I came across an article in the Wall Street Journal which examined the performance of various asset allocations for the period 1973 to 92. The article was based on research done at the T. Rowe Price Mutual Fund Group. The technique used was quite simple. Imaginary portfolios were constructed from various combinations of U.S. large and small stocks, foreign stocks, and U.S. bonds, and returns and risks were calculated. The article pointed out that over the 20-year period studied, various fixed mixes of the above assets outperformed the single component parts, as well as most professional money managers, with significantly lower risk. I was intrigued. T. Rowe Price kindly sent me the data underlying their calculations, which I analyzed. The results were astonishing. Almost any reasonably balanced fixed combination of the four assets outperformed most professional money managers over the same period. For example, a simpleton's portfolio consisting of 1/4 each U.S. large stocks, U.S. small stocks, foreign stocks, and U.S. high-quality bonds had a higher return with much lower risk than large U.S. stocks alone, represented by the S&P 500 index. The S&P 500, in turn, performed better than 75% of professional money managers over the same period. I was fascinated by the T. Rowe Price data. Here was a simple tool for ascertaining historical asset allocation performance, collect data on the prior performance of various asset classes, and backtest returns and risks. To my disappointment, I could find no readily available software which accomplished this. I would have to write my own spreadsheet files. I began to buy, beg, steal, or borrow data on a wide variety of assets over several different historical epochs and built portfolio models going back as far as 1926. The calculations performed by T. Rowe Price and myself contained an important implicit assumption that the portfolios were rebalanced periodically. Rebalancing becomes necessary after a while because some assets in a portfolio will do better than others, and this will alter the original portfolio composition. In order to rebalance the portfolio back to its starting composition, some of the better performing assets must be sold, and the proceeds used to purchase more of the poorly performing assets. Most experienced investors learn that the key to long-term success lies in a coherent strategy for allocation among broad categories of assets, principally foreign and domestic stocks and bonds. They also understand that market timing and stock or mutual fund picking are nearly impossible long-term. They are at best a distraction. Put another way, it is far more important to come up with the right proportion of foreign stocks, U.S. stocks, foreign bonds, and U.S. bonds than it is to pick the best stocks or mutual funds, or to call the tops or bottoms of the markets. As we shall see later, nobody consistently calls the market, and almost nobody picks stocks or mutual funds with any persistent skill. If you find this difficult to believe, consider the following. 1987 was not a great year for the U.S. stock market. U.S. large company stocks, represented by the S&P 500, gained only 5.23% that turbulent year, and small company stocks actually lost 9.3%. On the other hand, foreign stocks gained 24.93%. The clumsiest foreign fund manager would have beaten the most skillful small stock picker that year. In 1992, the opposite would have occurred when U.S. small stocks gained 23.35% and foreign stocks lost 11.85%. Finally, the 1995 to 1998 period provided unprecedented returns for the biggest U.S. growth stocks, but battered almost everything else. Still not convinced? In the late 1980s, Gary Brinson, a noted money manager and financial analyst, and his colleagues published 2 sophisticated statistical studies of 82 large pension funds. They concluded that asset allocation accounted for over 90% of the return variability among the funds, with a less than 10% contribution from market timing and actual stock and bond selection. In other words, asset allocation policy was 10 times as important as stock picking and market timing combined. In recent years, many observers have suggested that the 90% figure is too high. Perhaps asset allocation accounts for only 50% of return variability. Such arguments completely miss the point. Market timing and security selection are obviously important. The only problem is that nobody achieves long-term success in the former, and almost nobody in the latter. Asset allocation is the only factor affecting your investments that you can actually influence. It is thus truly astonishing that so much ink and airtime is wasted on analysts' predictions of the direction of stock or bond prices and on particular stock and mutual fund recommendations. In fact, when Mr. Brinson himself appeared on Louis Rukeyser's Wall Street Week in 1994, almost all of his comments were directed toward market timing and almost no attention paid to asset allocation strategy. The gambling instinct is ingrained in human nature, and few can resist speculation on events that cannot be foreseen. So how do you arrive at the allocation that will provide the most return with the least amount of risk? You can't. But don't feel bad, because neither can anyone else. Not even Mr. Brinson, who until he retired had more assets under management than any other individual on the planet. Sure, you can look at historical data and examine what has worked in the past, but don't confuse that with what will work in the future. Later, we shall look at historical data and attempt to extract from it useful portfolio advice, but the lessons are sparse. First, stocks are riskier than cash. Second, in the future they will probably have higher returns than cash, but not by as much as in the past, particularly the recent past. Third, portfolio diversification reduces risk. And last, index your investments wherever you can. In fact, if you tire of reading this book and simply want a recipe for a serviceable portfolio, consider the following advice. Purchase the above-mentioned Simpleton's portfolio consisting of index funds, 1/4 each of U.S. large and small stocks, foreign stocks, and a short-term U.S. bond fund. Index funds have become almost as commoditized as computer chips and gasoline, and they are available through most large fund families and supermarkets. I highly recommend Vanguard. At the end of each year, rebalance your accounts so that each of the 4 parts are again of equal size. That's it. Setting up the account should take about 15 minutes, and the annual rebalancing should also take about 15 minutes. You can forget about investing for the rest of the year. If the next 20 years are anything like the last 20, then you will outperform the portfolios of 75% of all professional money managers. In 1996, I placed this book's first edition online and began writing regular pieces for my website, Efficient Frontier, www.efficientfrontier.com. The reaction to it exceeded my wildest expectations. The hunger of small investors for information about asset allocation and portfolio theory was gratifying, but the response that I received from investment professionals was completely unexpected. Yes, I was told, we all know how important asset allocation is, but its nuts and bolts, the roadmap, if you will, were not at all obvious. The magic of the Internet put me into contact with dozens of folks who shared my fascination with portfolio theory, some well known, many not. 2 more electronic editions followed. These revisions, the dozens of website pieces, and the many discussions about investing and portfolio theory which followed, form the basis of this print edition. Readers will notice several changes from the previous electronic versions. First and foremost, the emphasis on indexing has become even stronger. I've come to the conclusion that active portfolio management is a sucker's game. Although in some areas, like small stocks, REITs, real estate investment trusts, and foreign stocks, active managers appear to be doing well, this outperformance is illusory. I've eliminated most of the sections describing the manual calculation of various portfolio statistics. Spreadsheets and financial calculators have made manual techniques obsolete. I suppose that it adds to the understanding of statistical concepts, such as standard deviation, to be able to calculate them by hand, but you'll have to look elsewhere if you want to learn how to do this. I've also adopted a new algorithm for the calculation of rebalanced portfolio returns, and happily abandoned the spreadsheet optimization employed in previous versions. In the past few years, the investment industry has embraced electronic commerce and made a dizzying variety of tools and vehicles available to the investing public. Unfortunately, most of it is so much rope: fund supermarkets, online trading, and an enormous volume of securities research, with which most investors will hang themselves. But for the prudent investor, benefits abound. The explosion of the Internet has brought a plethora of useful services and made the brightest minds in modern finance available to anybody with a computer, modem, and phone line. Second, and even more important, is the proliferation of inexpensive indexed investment vehicles. Now, even the smallest investors can build portfolios as efficiently and almost as cheaply as the biggest players. Introduction. Imagine that you are suddenly transported to a country you have never before visited. Trying to find your way home, you are told that there is a new, well-equipped, comfortable, and reliable car parked nearby. You are handed the keys and told to drive to an airport several hundred miles away where a flight home awaits you. What do? Do you stride to the car without further ado, drive away, and hope that by luck you can pick your way to your intended destination? You hesitate. It does not go unnoticed by the locals that you are a rube, and further the proud driver of an expensive automobile. Several sleazy characters crowd around you to offer their expert assistance. Do you trust yourself to one of them? Hopefully you do neither, and instead find the nearest bookshop, purchase a detailed road map, and plot the most efficient route to the airport. Only then do you start on your way. Most investors find themselves in a very similar situation. Many choose the first course and begin their investing careers with bold action, usually committing a large amount of their capital to a very risky market sector at or near its top. They rarely have a clear idea of exactly where they are headed or how to get there. Many more know that they are lost and depend on the kindness and expertise of strangers, otherwise known as account executives or financial planners, to find their way. All too often, the interests of these experts are very different from their clients. Learning how to invest successfully on your own is much like getting from one city to another in the manner of our fictional traveler. The road map is a simple one and will be briefly described below. The route will pass particular landmarks in a precise order. Each one will be described in its own chapter. The journey will be slow and painstaking at times, and there will be no shortcuts. This book cannot be read quickly. It must be methodically consumed, one page and chapter at a time. The Road Map. 1. Take a deep breath and do nothing for several weeks or months, or as long as it takes to complete the following steps. You are in no rush to immediately and radically alter your finances. You have the rest of your life to get your affairs in order. The time you take learning and planning will be time well spent. 2. Acquire an appreciation of the nature of and fundamental relationship between risk and reward in the financial markets. 3. Learn about the risk-reward characteristics of various specific investment types. 4. Appreciate that diversified portfolios behave very differently than the individual assets in them. in much the same way that a cake tastes different from shortening, flour, butter, and sugar. This is called portfolio theory and is critical to your future success. 5. Estimate how much risk you can tolerate, then learn how to use portfolio theory to construct a portfolio tailored to produce the most return for that amount of risk. 6. At this point, you are finally ready to purchase individual stocks, bonds, and mutual funds. If you have succeeded in the above tasks, this is by far the easiest step. The Intelligent Asset Allocator will take you through the above steps chapter by chapter on your journey to a coherent and effective lifetime investment strategy. Can you invest successfully without acquiring a solid understanding of risk and reward in the capital markets and of portfolio theory? Certainly. Many people have done so. It is also possible to learn to swim or to fly an airplane without lessons. I don't recommend it. Chapter 1. General Considerations. Imagine that you work for your rich but eccentric Uncle Fred. He is a conscientious and kind employer, and after you have spent some years in his service, he decides to let you in on the company pension plan. You are 30 years old and will work for your uncle until you retire in 35 years at age 65. Each year, he will contribute $5,000 to your retirement account. Further, you must pick ahead of time one of two investment choices for the duration of your employment. Option 1, certificates of deposit with a 3% annualized rate of return. Option 2, a most peculiar option. At the end of each year, Uncle Fred flips a coin. Heads, you receive a 30% investment return for that year. Tails, a minus 10% loss for the year. This option will be referred to as Uncle Fred's coin toss, or simply the coin toss. The first choice gives you a fixed rate of return, and in fact an absolutely certain lump sum at the end of your 35 years. You are adept with a financial calculator, and in a few seconds you determine that this option will yield a sum of $302,310 with which to support your golden years. You realize that inflation will diminish the future value of this princely sum. In fact, if inflation is also 3%, you will be left with only $107,436 of current spending power. The second choice confuses you at first. The thought of losing 10% of your hard-earned retirement money with the toss of a coin is too much to bear. What if you have a string of losing years? If you get tails all 35 years, you could be left with only a pittance for your retirement. On the other hand, if you get heads all 35 years, you know that you will bankrupt poor Uncle Fred with your gains. He will owe you $162 million. Let's look a bit more closely at the second choice. Over a long enough period, you will get exactly half heads and half tails. If you represent this with an alternating series of heads and tails, then your return in each 2-year period is represented by 1.3 times 0.9 equals 1.17. The first-year return of 30% results in your account being multiplied by 1.3, while a 10% loss multiplies your sum by 0.9. For each dollar you had at the beginning of the 2-year period, you now have $1.17. You again get out your calculator and find that a 17% return at the end of 2 years is the same as an annual return of 8.17%. This is clearly superior to the 3% return of the first option. Of course, you could have a string of bad luck and get tails more than half of the time. However, with some trial and error on your calculator, you discover that you would have to get 12 heads and 23 tails before you come out worse than the first option, and you decide that the odds of this are quite low. You visit your former college statistics professor, who chides you for forgetting that you could have easily calculated the odds of any combination of coin flips with the so-called binomial distribution function. What are the odds that you will flip less than 13 heads and come out behind? less than 5%. Actually, this is a bit of an oversimplification. The order of the coin tosses matters a great deal. If you toss 16 straight heads, then 19 straight tails, you will still come out behind. But if you toss 27 straight tails followed by 8 straight heads, you will actually come out ahead. However, these are extremely unlikely events. The coin toss also introduces the difference between the average and the annualized return of an asset. Some of you may wonder why the return of the coin toss is not 10% instead of 8.17%, since the average of plus 30% and minus 10% is plus 10%. 30 minus 10 divided by 2. The average return is simply the average of each of the individual annual returns. The annualized return is a more subtle concept. It is the return that you must earn each and every year to equal the result of your series of differing annual returns. If you own a stock which doubles, has a 100% return the first year, and then loses 50% the next year, you have a 0 annualized return. If the stock was worth $10 per share at the start, it was worth $20 at the end of the first year, and $10 again at the end of the second year. You have made no money, and yet the average return is a so-called 25%, the average of plus 100% and minus 50%. Your annualized return is 0. The annualized and average return clearly are not the same. The coin toss has an average return of 10% and an annualized return of 8.17%. The annualized return is always less than the average return. If in the coin toss you come up with half minus 10% and half plus 30% returns, this is the same as having an 8.17% return each and every year. You pay your bills with annualized return, not average return. This is why annualized returns are so important. Uncle Fred's coin toss may seem a most bizarre scenario, and yet it is nearly identical to the choice faced by most investors between the safety of money market accounts or treasury bills and the gamble of common stocks. The second option offers a near certainty of a superior result, yet comes at a price, the small possibility of an inferior result, and more importantly, that gut-wrenching coin toss session with Uncle Fred each year. Yet it is the 3% certificate of deposit option which is the most truly frightening. You will almost certainly live your golden years in poverty. I constructed Uncle Fred's coin toss with some deliberation. It's easy to grasp and quite closely approximates the returns and risks of common stocks. The return of common stocks over the past 73 years, 1926 to 1998, was 11.22%, in the same league as the coin toss. More importantly, the riskiness of the coin toss and of common stocks are nearly identical. I shall explain shortly how to measure precisely this riskiness. The coin toss is a handy symbolic representation of the risks and returns of common stocks. It will also provide a powerful way in which to understand the behavior of portfolios with multiple asset types. You have just been introduced to one of the fundamental laws of investing. In the long run, you are compensated for bearing risk. Conversely, if you seek safety, your returns will be low. Experienced investors understand that reward and risk are inextricably intertwined. One of the most reliable ways to spot investment fraud is the promise of excessive returns with low risk. Chapter 2. Risk and Return. Individual Asset Classes, 1926 to 1998. You should now have a grasp of the statistical meaning of return and risk. You are ready to tackle the long-term historical record of a wide range of assets. Presumably, you would not purchase a car or refrigerator without checking its performance and repair record in a suitable publication like Consumer Reports. In a similar fashion, you should not commit a sizable portion of your disposable income to an investment without a good idea of its expected return, performance, and risk. repair record. Fortunately, there is a large amount of useful data out there waiting for you, and it is easily accessible and cheap. How long does it take to get a good idea of the long-term return and risk of an asset class? Opinions vary, but at least 20 or 30 years of data are necessary to get a good idea of expected return. You can get a good idea of asset risk by looking at monthly data for not much more than 5 or 10 years. When it comes to U.S. securities, we are sitting in clover. There is usable data going back to the birth of the Republic regarding common stocks and government bonds, and extremely detailed data going back to 1926. One of the great bargains in the investing world is the Ibbotson monograph, Stocks, Bonds, Bills, and Inflation, known in the investing world as the SBBI. This contains every possible breakdown for returns, risks, and correlations of a large number of U.S. assets for periods ranging from a month to decades. We shall consider 5 assets: large and small U.S. stocks, and 30-day, 5-year, and 20-year Treasury securities. Let's review each asset individually. The terminology for government securities is confusing. A security of less than 1 year is called a Treasury bill, or more simply a T-bill. An obligation of 1 to 10 years is called a note, and of greater than 10 years, a bond. Treasury bills. A Treasury bill is the safest investment on earth. Short of national destruction, there is no possibility of default, although Uncle Sam occasionally prints money to make good. The price paid for this safety is steep. The return is only 3.77%, which is barely above the inflation rate of 3.08% for the 1926 to 1998 period. Further, although many academicians consider T-bills to be riskless, you cannot depend on a constant income stream. The best that can be said for the performance of T-bills is that they keep pace with inflation in the long run, although there were prolonged periods when even this was not true, particularly in the 1970s. Intermediate term, 5-year Treasury notes. Like T-bills, intermediate term, 5-year Treasury notes offer near absolute protection from default on principal and interest, but do carry one risk, that of rising interest rates. A note or bond yielding a fixed coupon will decline in market value when interest rates rise, and the longer the maturity of the note or bond, the worse the damage. At a maturity of 5 years, the loss in principal market value can exceed the coupon of the note or bond, resulting in a negative total return for the year. This has happened 7 times in the past 73 years, and in fact, the worst loss for this period, 2.65%, occurred in 1994. For bearing this risk, you were rewarded with another 1.5% of long-term return. In the long run, the real, inflation-adjusted return was about 2%. Long-term, 20-year Treasury bonds. Long-term Treasuries behave in much the same way as the intermediate notes, except that their interest rate risk is much worse, producing losses in 20 of the past 73 years, with one loss of nearly 10% and many losses in excess of 5%. Surprisingly, you do not seem to be rewarded at all for bearing this risk. The return is almost identical to that of 5-year notes. Why do so many sophisticated investors invest in long bonds when they can have the same return with less risk with intermediate bonds? The answer, which we shall explore in later chapters, is that much of the excess risk of long treasuries disappears in a properly constructed portfolio. That part of the risk that disappears with diversification is called non-systematic risk, and that part which remains and cannot be diversified away is called systematic risk. There is another reason why the returns on long treasuries and other long bonds are so low. They are a favorite investment of insurance companies, which have long-lived fixed liability commitments that can be precisely offset with long bonds. In fact, there are many assets whose apparent risks seem out of proportion to their meager returns. The best example of this is the class of precious metals stocks, with real long.
Sample complete. Ready to continue?